Oh my goodness, do we have lots to talk about with Shift Technologies. What is going on, everyone? Hope y'all are doing well. And in this video, I'm going to share what on earth just happened with Shift Technologies in their earnings report and conference call. I just talked about this company a couple of weeks ago, and with this company being a popular stock on my channel and some major news, it only makes sense to get this video out as soon as I can. But I don't want to waste your time, so let's go ahead and dive right in. Okay, so before we get into the actual earnings call, let's talk about the price action. Shift hit an all-time low of 60 cents back on June 16th, and for about a month and a half, the stock went on an absolute tear, reaching a high of about $1.50. And right before earnings, they fell over 25%. Now, some people were looking at this and were wondering if any news came out for the company that made this drop happen, but there was nothing. However, I think I found the culprit. JP Morgan announced that they downgraded Carvana because of the risk of profitability. I think this was one of the major reasons because not only was Carvana down a ton, but so was Vroom. But I think another reason for the drop was that Vroom posted horrific numbers when it came to their revenues. They missed analyst numbers by 12% and were cut in half from the previous quarter. So there was not a lot of good news entering Shift's earnings report. But let's go ahead and look at what Shift posted for numbers. So the company was expecting between $225 million and $235 million in revenue, and they reported $223 million. Analysts had the company doing $234 million, and so honestly, this miss doesn't look good. But there is some major news that I wanted to share, so make sure that you stay till the end of the video. This quarter did give me cause for concern because analysts had high expectations. Now, EPS, or earnings per share, is always something that they have struggled with. Analysts projected them to have a loss of 55 cents a share, and they actually had a net loss of 64 cents a share. So this double miss does not look good, and honestly, the rest of the numbers don't look good either. There are a couple things that impact EPS that I think are more important indicators for the company. The first one is the second quarter GPU, which is their gross profits per unit. One thing that I've said numerous times that is a caution flag for Shift and other used car e-commerce companies is that they have razor thin margins, so improving gross profits are extremely important. Now, there are two pieces to the GPU. One is the actual car itself, by buying the cars from consumers, doing the maintenance, and then selling them on the market. So on this side of GPU, they get forced equity through their maintenance and any fees that come from Shift itself. The company had GPU expectations between $1,800 and $2,000, and they actually had $1,700. But the second piece is, in my opinion, the most important, and that is their adjusted other GPU. When you think about the car industry, there's only so much you can do to add value to the vehicle and receive fees through their transactions. So you need to rely on services outside of the car itself, and that is where this other GPU comes in. This category includes the term F&I, or financing and insurance. Shift reported adjusted other GPU of $1,364. So this was the only metric that I was actually pleased with when it came to this quarter's numbers. Even though GPU is an important metric when it comes to EPS, another is their adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. This is the metric I like to use to get an idea on how they are doing with moving towards profitability. The range that Shift estimated for the quarter is between negative $37 million and negative $39 million. They actually reported negative $36.9 million, so they barely beat expectations. Now, I think for many of us, the biggest caution flag is the amount of cash burn that Shift has had in the past. In Q1, they burned so much cash that they cut their cash and cash equivalents over half. But the major reasons for the significant cash burn is the $38 million in investments toward inventory and an annual incentive payment. This quarter, the company maintained about $88 million in cash compared to $107 million in the previous quarter. So this was really nice to see. And the last thing that I was looking for is an update on their guidance. With back-to-back quarters of GDP decline, there could be less people wanting to buy cars. And so I really wanted to see how this environment will affect Shift if we see demand fall. In the last quarter, they had revenue guidance numbers for 2022 between $1 billion and $1.1 billion, with analysts expecting more on the lower side of the estimates. But for the rest of the year, they're only expecting between $270 million and $290 million in revenue. That means that they will have a total between $690 million and $710 million. Now, these numbers look horrific and looks like a cause for concern. However, even though I see part of the reason being a lower demand for used vehicles, I actually think that there is a greater reason, and it is because they want to reduce costs for the major news that I will talk about soon. The second part of the guidance that I was looking at is if they will maintain their adjusted GPU, which is projected to be greater than last year. This one is dependent on their F&I, because if we see demand fall, so will the prices, and the appreciation that we see in used cars over the past year will not be able to carry them to profitability. Unfortunately, they are expecting to only have between $1,600 and $1,700 in GPU, which is significantly lower than what they guided. But before we move into the next thing, I think we can all agree that Shift is a high risk, high reward play. And that is why we can accept some of the caution flags that exist with this company. Regardless, I do not want to put all my money into one stock, especially a company with high risk. But just like the stocks, I like to diversify my brokerages too. I've tried several different platforms, but one I really like using is Moomoo. They're doing a promotion right now where you can get up to 7 free stocks when you deposit $100 to the platform, or 10 free stocks when you deposit $2,000 to the platform. Think about it, that's literally free money for you. As someone who has used many platforms, the Moomoo app is a really clean and easy app to use. You can buy stocks both on the US stock market and the Hong Kong market as well. Plus, there are no fees for trading US stocks if you are a US resident. And if you enjoy technical analysis, which I know several of you do for a company like Shift, they have free level 2 data as well. So if you're interested in using Moomoo, click the link down below in the description to get started. This promotion only lasts until the end of August, so make sure you sign up before it ends. All right, now the major news that I don't think anyone expected. On August 9th, Shift announced that they are merging with Carlotz. Now the merger itself is great news, but honestly, I'm more impressed with the effects of this merger when it comes to the synergy between the two companies. So here's what they have so far. Carlotz is a leading used vehicle consignment business, and when you merge their expertise and mid-Atlantic region presence with Shift's technology and presence in the West Coast, this makes this combined company extremely dangerous in the used car e-commerce sector. But I think the one thing that makes many investors somewhat relieved is the business plan is expected to be fully funded to profitability from the cash position with both companies. And this is the reason why I think that they are reducing the amount of vehicles that they are actually selling. Because they are a cash losing company, they want to reduce the amount of cars sold so they can preserve more cash, so that when this deal goes through, they will have the finances to fund them through profitability. With this merger, the new CEO will be the president of Shift, Jeff Clements, and will begin on September 1st. Honestly, I think this is hands down the best move for the company. When it comes to Clement's expertise with leading the team for Walmart.com, I think with him at the helm puts the company in the best position not only to succeed on revenues, but generate solid profits as well. And speaking of profits, with the new business model, the company is projecting positive unit economics in 2023 and company-wide profitability in 2024. They're not anticipating to need additional capital to break even. And this is significant because it's always been a stress for Shift shareholders. The company is really focusing on their online presence, and because of their operational changes, they will be reducing the workforce across their entire business. They are reducing 60% of their corporate positions and frontline roles, which will significantly reduce overhead costs. Now, I do feel bad for those that are losing jobs because I know that must be hard. However, when we look at the business now for Shift, they are in a much better position overall to get to profitability. Now, Carlotz locations are expected to be break even in 2023, and then Shift will follow suit in 2024. So the question then becomes, how will they get closer to profitability? Well, for Shift, it is based off of 4 main things. First, they are focusing on lower volumes and shifting more to online. With Carlotz already close to being profitable, plus Shift's online checkout, they won't need as many transactions to achieve the profitability that they have been looking for. Second, they are placing their attention on high margin units. Rather than needing to sell a bunch of cars to achieve profitability, they can focus on cars that will give them the best return, which will improve their gross profits per unit. They do this by switching more to value vehicles over core cars. Value vehicles are those 8 years or older or that have 80,000 miles. Third way to help achieve profitability is through automating much of their operations. For now, the temporary elimination of in-person test drives and focus on the online checkout channel could reduce about 40% selling costs per unit, once again driving the margins up. And the last way is through reducing their marketing expense and, as I said already, reducing corporate headcount to reduce all overhead costs. Both of these are going to put the company in a position where they can reduce cash burn while still being able to grow their customer base. So even though their guidance for the rest of the year is not good, I think that the preservation of cash is most important if the combined company wants to stay on their new projections toward profitability. But this is something that I have to say. This merger has not officially gone through yet, so please consider that before buying the stock. A lot of people are buying the news. We have seen companies over the past few years enter a merger with another company that fell through. I recognize that this continues to be a risky play, and that is a major reason why it is one of my smallest positions in my portfolio. There is still a possibility that this company could go under, and I think it's something that everyone needs to consider before buying or adding shares to this company. So please know your risk tolerance before investing. But hey, Hey, I hope you all enjoyed this video, and if you did, smash that like button down below. That helps this channel in a massive way. Also, follow me on Instagram at JonnyOswald64 to see more content where I talk about budgeting, investing, and building wealth. And don't forget to sign up with Moomoo, where you can get up to 7 to 10 free stocks depending on how much you deposit to the platform. Also, I would love to hear your thoughts about this merger, so let me know in the comments down below. And if you're new here, hit that subscribe button and notification bell. That way you're notified when new content comes out. Hope you all enjoy the rest of your week, and I'll see you in the next one.